All right. Hello, everyone. This week we are going to be covering chapter 15, which is called Money and the Financial System. I think that you guys will find that it's extremely relevant to what is going on in our economy at this time. So the first thing I want to talk about is money. So obviously we all, use dollars, these, um, you know, paper created, paper um, dollars that represent essentially a value, right? So these are the ones that circulate in the United States. Every country has their own, but in our case, the dollar, the U.S. dollar, is very powerful, and it's a lot of times accepted in many other countries. But this is essentially, this no promissory note from our government. It's, if you look here at the top of the dollar, it says the United States of America. So, and it says on the top, Federal Reserve note, $1. So it's a promissory note from our government that this paper is going to represent $1. So it's a value that's promised on behalf of the government. So just here a couple of other, obviously this is an older one. The paper dollars were first introduced during the Great Depression in the 1930s. So previously, before they introduced the paper dollars, people would exchange other stuff like cattle, gold, silver. A lot of different cultures traded a lot of different things in exchange for goods and services. And so it isn't until the 1930s during the Great Depression that the US introduced the paper version of the dollar. So just a quick little history on that. Money in the financial system. We're starting this chapter to talk about money because I want you guys to sort of put that perspective in place that, this is the one tool that we use to measure wealth, personal and business income and wealth. A lot of times you're asked, what is your income? And that's what we use to measure, right? And it's anything, money or currency is anything that's generally accepted in exchange for goods and services. As I mentioned in the previous slide, we used to use salt, cattle, gold, silver, lots of different things that we've exchanged in our history. But the fiat money is what we and most countries use today. So fiat money is what is referred to as paper money. Obviously, paper can be converted into anything else. It's just our paper money, and it represents the value that the government promises. So whatever it says on the dollar, on the paper, that is what the value will be. So it's the value that's specified on the note. So that's kind of how we view money. Finance is the study of how that money is managed by individuals, companies, and government. The function of money is to, obviously, you're going to trade money for a good or service. We use it as a medium of exchange. So it's, freely converted to any other, any other good or service, depending upon the agreement between the parties. So as long as, you go to Best Buy and they're willing to exchange a TV for your money, then that's the medium of exchange. The second function that money has is a measure of value. So it's the common standard of value that we use for the goods and services. So for example, we can go to the store and buy eggs for $2 and we can buy a car for $25,000. But if we tried to go buy eggs, they wouldn't cost us $25,000. So it's sort of a common measure of value. And then of course it stores value. So, you can accumulate wealth. You can, put it in your savings account and store it until it's needed. And so that's something that a lot of people can do, but with the consideration that when you do save it, you have to deal with inflation. So it's like the whole basically prices double, so your purchasing power falls if those prices increase. So you can save your money under your mattress, and today you can buy a $25,000 car with the $25,000 you have under your mattress. But maybe in 2 years that $25,000 won't be worth the same amount. Maybe it'll be worth less. And so maybe you won't be able to afford that same $25,000 car, by storing your money under your mattress. for a long period of time. So that's inflation. And then there's also deflation, which is when prices of goods fall. So typically when there's deflation, it's an indicator that there's problems in the economy, that there's slow economic growth, or decrease in wages, falling prices. And that's, one of the things that, that's a consideration for what's going on right now. So some of the characteristics of money. So in order for money to be able to be used as a medium of exchange, it has to be, it must be acceptable. So most most of the people that use it have to accept it as, okay, this is actually worth $1, or this is actually worth $100. So people have to trust in the value of it in order for it to work. It has to be divisible, which means that a dollar can be broken up into quarters, pennies, dimes, nickels, that sort of thing. It has to be portable, so it has to be easy to move. If you have $100,000 and you want to buy something, think about moving $100,000 worth of gold bars versus taking cash, right? So it has to be easy to move around in order to purchase things. And it has to be stable, right? It has to maintain the face value. So if I go kind of going along the same lines of the inflation and the deflation thing, if I go to the store and I try to buy eggs and it costs me $2 today, I want to make sure that I can still go to the store and buy eggs tomorrow for $2, right? So it has to maintain the value, and people have to accept it for that same value. If I have a $5 bill and I go and buy something today, and I go try to buy the same thing tomorrow, if the clerk tells me like, oh, that's not enough, or we need more money in order for you to buy this same thing, then something's wrong there. It has to be durable. So most dollar bills remain in circulation for about 6 years. So they have to be able to last and go through many, people. So they have to be durable. If you have a dollar bill that rips really easily, or if you throw it in the washer and it dissolves, then you lose your money. So it has to be durable. And in order to remain stable, it has to be difficult to counterfeit. So people have to understand that, it's valuable. It's not going to be easy to duplicate this dollar, because the way that it's made creates barriers for people trying to counterfeit it. So if you're a business owner and someone pays you with $1, you trust that it's a real dollar and not a counterfeit dollar, because our system is created in a way that really makes it hard for people to do that. And if people didn't trust that counterfeiting US dollars, if they didn't trust that it was difficult to do that, then it would be hard. There are counterfeit machines and markers that are created because it still happens, but there are systems in place to catch them. And so when that happens, there are some pretty harsh penalties, for doing that kind of thing. So it's a big crime to do that. So some of the different types of money. This is just a picture of some of the U.S. government printers for the U.S. dollars, and so you can kind of see what that looks like. But they have a lot of things that they've incorporated over the years, like this little ribbon. They have, if you hold them up, some of these areas have textures. I've had students in my class that have worked at banks, and they have shared some of the areas that they have certain texture that they can feel and see if that is a real dollar or not, based on how that feels. So it's pretty interesting to see how they've evolved over time, but lots of different elements that have been incorporated into the dollars in order to ensure that people are not counterfeiting them. So some of the different types of money that we use, and then the forms, I guess, that we use, like if, for example, if I have $100 in my bank account, I have the money. If I go to the bank and pull it out, they'll give me $100, but I don't physically have the dollars on me, but I know that they're in my checking account, right? And so the different types of money are paper money and coins, which are the physical ones that we can put in our pocket and go, buy a popsicle from the ice cream man or something. We have the paper and the coins. There's also checking accounts. They're called demand deposit accounts, and that's what I was just talking about, where your money is stored in the account at a bank or another financial institution, and they can be withdrawn without advance notice, right? So you can take the money out whenever you want. I feel confident that I can go to the bank and say, I would like to withdraw my money, and it will happen. And this is partly because of the FDIC. I don't know if you guys have ever seen those little notes when you go to the bank that say FDIC insured. So that means that the federal government basically guarantees that if you go to that bank and try to take your money out, they will give you your money. So that's a basic checking account. Then there's also savings accounts. These are accounts that usually you can't withdraw without notice, or they have limits on the number of withdrawals per period. So for example, I have a savings account that only allows me to withdraw, I think it's about 6 times per month is my maximum. And if I withdraw more than 6 times in that month, then they convert it to a checking account. So typically they have some limits, or depending on your bank, they'll say you can't withdraw it without a notice and things like that. And this is because they want the bank wants to kind of have an idea of how much cash it should have on hand. And so it counts the checking account balances as the ones, okay, this is how much money we should have on hand in case a customer wanted to, withdraw that. And so, of course, once we have money in our checking or savings account, we then have, particularly for the checking account, we have checks, right? And so we use checks. I don't know if you guys use these too often. I think as you get older, you probably use them more. And they were very big for some time before the ATM cards came out. We would have to pay with checks at the store. So when you want to transfer money from your account to another party without necessarily having to withdraw it and all that, it's become a lot safer to do so using checks. So a lot of people use these to pay rent or utility bills, things like that. Most of the time, companies have now transitioned to everything online, but there are some cases where checks are still required. And so that's, basic check. You have for those of you that have never written a check, you put the name of the person, how much on this side, and then you have to spell out the amount here. And then, you're not required to put anything in the memo section, but this is typically where you sign. And then the banking numbers on the bottom are the one that these are the ones that provide the bank with the authorization of which account to take that money from. So they provide the bank info. Okay. So other types of money in the financial system are money market accounts. And these are accounts that offer higher interest rates than a standard bank rate, but they have more restrictions. So they're similar to interest-bearing checking accounts. Generally, in exchange for a slightly higher interest rate, the owner of a money market account can write only a limited number of checks each month. So there may be a restriction on like the minimum amount of each check. It kind of reminds me a little bit of a savings account, but it's a money market account. And then there's also CDs. I don't know if you guys have ever seen these announcements or boards at the bank, but they're basically a savings account. So they'll say, if you leave your money in the bank for 3 months or 6 months or 9 months or whatever the length of time is, they provide you with a guaranteed interest rate. And so if you take that money out before the time is up, then they do a penalty. They charge you a pretty big penalty. So you have to really be in a place where you can't leave the money in there. And so some of them the most common ones that I've seen are like 6 months or a year or even 7 years. I've seen sometimes even longer. And again, they'll say, we'll pay you 3% interest if you leave your money here for 6 months or 9 months or whatever. In my experience, these rates have been very low. I think in my personal opinion, I think it's better to invest it in other things, but a lot of people do it, and it's completely fine. It's just based on your preference. And then there are credit cards. So credit cards are a way for you to access a pre-approved line of credit. So it's granted by a bank or a finance company. They basically they're popular for substituting cash, and you promise to pay a lender. Basically, you promise to pay them at a later date. And some of the advantages are it's convenient, it's easy to access credit. Sometimes if you have like a good history. They're accepted all over the world, so they have a lot of advantages. Sometimes they'll offer special rewards. Like I know Southwest has one that if you use it a certain amount of times, or if you charge a certain amount of money, they'll give you free flights over the year, or a free flight, depending on how much you use it. And then there's been a lot of regulations that have been passed to make it, to make it reasonable for consumers to have credit cards, because they can be very dangerous, particularly for younger people, because you don't necessarily understand how much the interest is that you'll have to pay over the life of the loan that you get. And so when you don't understand that, it's really easy to get into a lot of debt really quickly. So things that some of the people have created regulations for are like the rates, the maximum rates that credit card companies can charge. They have a lot of limits for young people. So they'll say like, okay, we'll give you a credit card, but it's only for $800 or that kind of thing. Sometimes they might require a cosigner for people under the age of 21. And sometimes they'll give you a little bit more time to pay depending on your situation. I know with the coronavirus, for example, they're offering the ability for people to call their companies and say, hey, I have lost my job as a result of the coronavirus layoffs, and I would like a moratorium or a kind of like a pause on my payments. And a lot of companies are doing that. But the key is that if you do that, you have to call and you have to say, you have to actually say the word coronavirus, otherwise they won't, or COVID-19, otherwise they won't grant you kind of the break or the relief to those monthly payments. So pretty interesting. I always like to recommend to my students that, especially if you're just starting your kind of managing your personal finances and things like that, I always recommend that students get credit cards, but I always recommend choosing one that's student friendly. A lot of companies, a lot of banks have student cards. And I always recommend doing it soon, because the sooner you establish your credit, the easier it will be for you to, get bigger loans in the future. So if you want to buy a car, if you want to buy a house, that kind of thing, they will always check your credit. And one of the things they check is the history of your credit score. So they'll check how long you've had a credit card or any kind of, loans or anything like that. They'll check the length of your credit history, and that's one of the things that impacts your score. So I recommended it to my younger brother, he's 22 now. He's in college. I got my first credit card when I was 18, and I got a student card. I think the max was like $500. But I think the key is just that you understand that you're getting it to build your credit, not to go shopping, right? So you want to use it for emergencies, but you always want to be able to understand that typically credit cards have a really high interest rate. So, if you have, let's say that you want to buy your books for the semester and they're $100, or maybe you want to buy a laptop and it's $1,000, right? So if you go and buy that laptop and it costs you $1,000, a lot of the companies will sometimes have interest rates that are, 25%, for example. And so of that $1,000, you're going to have to pay $250, in interest. And so you have to sort of think about, okay, how is this going to go? How long is it going to take me to pay it back? Because you have to understand that the credit card does let you borrow the money, but they're charging you a high interest to do that. So that interest has to be incorporated in your repayment thought process, so that you understand. And nowadays, one of the things that they've required credit card companies to do is to list on the statement how long it would take you to pay back that loan if you made just the minimum payment. So that's the other thing. You always want to be able to be in a place where you can make more than the minimum payment, in order to pay it off faster. Otherwise, you end up paying a lot for a small purchase because of the high interest rates. So just things to consider. But I always think it's good to start your credit early, to start creating that credit history, and be very smart about how you use them, because it's, like I said, it's really easy to get into a lot of credit card debt. So the other kinds of money that we use in our financial system are debit cards, which, as I mentioned earlier, we use those a lot now rather than a check. It's immediate electronic payment, right? So we use those. I know that you guys are pretty familiar with those. We have something that's called near money. So these are traveler's checks or money orders or cashier's checks. So it's a piece of paper, but it essentially, it's kind of like a check, only it's not necessarily tied to an account. The actual paper is what's kind of worth the money. So I've used these a lot for some of my tenants will pay their rent with money orders because they don't have a checking account. So you go to a grocery store, you go to the post office, and you say, I would like to purchase a money order, and they will sell it to you. They're not too expensive, but you'll give them, $500, and then they give you a piece of paper that says money order for $500 from the post office. So then you use that in lieu of the cash itself or a check. And then I've used a lot of the cashier's checks when you purchase real estate, or when I purchased my car. I paid a big chunk of it with the cashier's check, and so I had to take a cashier's check from my bank to the dealership to pay for it. And then the other one is a new one. It's called cryptocurrency. It's a new type of money, and it's become very popular over the last several years with a lot of tech people. Bitcoin is the most popular of the cryptocurrency, but it has a fluctuating price, so it's a little bit less desirable than cash because it fluctuates a lot. And cash, dollars and yens and euros, those are all backed by the government. So cryptocurrency is a little bit more, it's more of an unknown kind of entity, and some people feel very comfortable investing in it, and some people stay completely away from it. But it's also another type of currency. And then I want to talk now about the Federal Reserve. So the American financial system, is basically, it's guarded by the Federal Reserve Board. And so this picture on the right, that is the office of the Federal Reserve Board. The Federal Reserve, they call it the Fed. So if you guys have been following along with what's been happening in the country, the Fed has been in the news a lot lately. It's the guardian of the American financial system. It's an independent agency of the federal government that was established in 1913, and they were established to regulate the banking and the finance industry. And so, they're the policy kind of chief economic policy arm of the U.S. They work with Congress and the president to make sure that our economy is, continuing and thriving. They always strive to create a positive economic environment, and they are basically given the tools to sustain, inflation. If we have high unemployment rates, their goal is to control the economy and manage it in a way that continues to foster economic growth. And so, as you can imagine, right now, with things the way that they are, it's really kind of come out of the weeds, and it's been very active in terms of actions that it's taken in order to help the economy. And so, I wanted to talk a little bit about that so that you guys can kind of understand it a little bit better. So they have four major functions, and so you'll, recognize them, I think, from the video a little bit, but they have four major functions. The first is to control the money, the supply of money, or the monetary policy. The second is to regulate the banks and other financial institutions. The third is to manage the regional and national clearinghouse procedures. And then the fourth is to supervise the federal deposit insurance programs of banks. So, basically to make sure that that the money that's in our economy, that the money that's in our country is valuable, that our economy is thriving, and that everything is kind of flowing and fostering that economic growth. So in terms of the monetary policy, which I think this one, number one, is the one that is the most important right now. That is one of their major functions, and that is the one that they have been the most active in the last couple of weeks, in controlling the supply of money in the economy. And that's because because of the virus, our economy has come to a halt, which means that the level of money in our system has changed dramatically over the last 2 to 3 weeks. And so, in terms of the monetary policy, which is the first, the first one of their functions here, controlling the money, the monetary policy of the country. That means that they control the amount of money available in the economy. They intervene when it's necessary, and they aim to keep the supply and demand in balance to avoid inflation and deflation. And this, could result in rapid price increases, inflation because there's too little money, and then economic recession and slowdown of price increases, disinflation because of too little growth in the money supply. Anyway, so these are some of the activities that the Fed can take in order to have some kind of impact on the money supply. So you can see here, if they buy government securities, money supply increases, economic activity increases. If they sell them, the money supply decreases. If they raise the discount rate, interest rates increase. If they lower the discount rate, interest rates decrease. So this is one of the actions that they've taken. If they increase reserve requirements, banks make fewer loans. If they decrease reserve requirements, banks make more loans. So that's another thing, and you have to think about it. If you're the Fed, which activities would you, say would be the best option for us right now? So anyway, so these are some of the things that they are doing in order to take on this crisis head on. So the open market operations, it was mentioned in the video briefly, but basically they buy or sell U.S. Treasury bills and other investments in the open market. The most commonly employed of all federal operations is this, and it's performed almost daily. And then the reserve requirements, which we said, it's how much money they require banks to have on reserve. So, if they have, however many accounts they have, they're required to have 20% of the money on reserve or whatever on hold. So they'll make those requirements. The discount rate is the rate of interest that the Fed charges to loan money to banking institutions. Lowering the discount rate encourages borrowing and expands money supply and vice versa. So this is the action that they took. Then there's credit controls, the authority to establish and enforce credit rules for financial institutions and private investors. And it allows the Fed to effectively control the total amount of credit borrowing in the stock market. Other functions of the Federal Reserve Board, they are it's the second major responsibility of the Fed, the regulatory functions. They regulate the banking institutions and they establish and enforce banking rules. So, this is a good example of how they, maybe if Wells Fargo is not behaving, they would have the authority to say, hey, Wells Fargo, what are you guys doing over there? So this is the regulatory function that they have. And then they have check clearing. So this is, and then the depository insurance. So the check clearing is a national check processing. So they're responsible for ensuring that, like, if there's a bank that's only in California and there's a bank that's only in New York, if I write a check to somebody in New York and I'm in California, my bank, even though it's going to cross city or state boundaries, it's still going to be, it's still going to hold its value and the check is still going to clear. So that's the check clearing function. And then there's depository insurance. So this is the FDIC thing that I mentioned earlier. So they supervise the federal insurance funds that protect the deposits of the banks. So they make sure that when you put money in the bank, that you have the ability to take that money out, when the time comes that you need it, and it will be there, and it's insured by the federal government. Banking institutions. So these are commercial banks, savings and loan associations, credit unions, those kinds of mutual savings banks. They accept money deposits from and make loans to individual consumers and businesses. So anybody, if you have a car loan, or whatever bank you have it from, if you have savings or checking account, that kind of thing. So these are businesses whose objective is to earn money by managing, safeguarding, and lending money to others. So that's their business. Their sales revenue come from the fees and the interest that they charge us as consumers for providing those services. So it could be fees, it could be, some people get charged for their accounts. Typically students don't. If you do get charged, you should try to find an account that's for students, because a lot of those won't charge you fees. But like some banks will charge you a monthly fee. Sometimes they'll charge you overdraft fees, sometimes, things like that. That's how they make their revenues. And that's why they're so good about charging you when things happen. So the four most important banking institutions are commercial banks. These are the largest and the oldest of all of them, and they rely mainly on checking and savings accounts. So think like Bank of America, Wells Fargo, Chase, that kind of thing. The sources of the funds for loans or businesses and individuals can also come from these commercial banks. So like I mentioned, if you have a car loan, things like that. Then you have savings and loan associations. These are often called thrifts, and they're financial institutions that primarily offer savings accounts, and they make long-term loans for residential mortgages. So, if you don't know what a mortgage is, it's basically a loan to buy a house. They're long-term loans, typically about 30 years, although there are some that can be shorter term, like 15. Many of them have merged with commercial banks, so you'll see like Bank of America will offer mortgages and things like that. So a lot of them have merged. And the other one is a credit union. I don't know if you guys understand the difference between the credit union, but typically it's a financial institution that's owned and controlled by its depositors. So you usually they have a common employer, profession, trade group, or religion. Credit unions were originally created to provide depositors with short-term source of funds with low interest consumer loans for cars, home appliances, and things like that. But now they offer a whole wide range of financial services. Like I have an account with school's financial credit union. Typically, they have lower fees, because they're owned by the members. So they'll typically have lower fees or more free account services and things like that. Mutual savings banks, these are similar to the savings and loan associations, but like the credit unions are owned by their depositors. Let's see, they're among the oldest financial institutions in the US, and they were originally established to provide a safe place for savings for working class people. They're mostly found in New England, and they're becoming more popular in the rest of the country. But a lot of the savings and loan associations have converted to mutual savings banks to escape the stigma, because the savings and loan associations had a big there was a time in our history when they just kind of failed, and they sort of continued with that reputation. So the FDIC stuff that I've been talking about, this is the insurance fund. It was established in 1933, and it insures your individual bank account. And if you guys have ever seen the sticker at the bank, it insures personal accounts up to $250,000. So there's over 6,000 FDIC member institutions. So if your bank ever fails and you have up to $250,000 in your bank account, the federal government guarantees that you will get that money back. So then there's the National Credit Union Association. This is the agency that regulates and charters credit unions and insurers. And so I think the reason why these exist is because during the Great Depression, 52 banks failed. I'm sorry, during the Great Depression, a lot of banks failed. During the recent recession of 2008, we had a big chunk of banks that also failed. So to give you an idea, so between January 2000 and December 31st, 2008, and that was during probably the most difficult time in the last recession. So again, in between January 2000 and December 31st of 2008, 52 banks failed. And to give you context, so that was between January 2000 and December 31st, 2008, right? But we started suffering the consequences of the recession after, right? So between the recession and the sort of recovery from the recession, between January 1st, 2009 and December 31st of 2014, 488 banks failed. And then between 2015 and 2017, 21 banks failed. So you can kind of see why this insurance is necessary, because it does happen, especially during times of crisis. So moving on here. So non-banking institutions, these are institutions that offer some kind of financial services like short-term loans or investment products, but they do not accept deposits. So they're diversified firms. So these are non-financial firms that help people buy their big purchases. So think, for example, like I think of them as like finance subsidiaries. So a lot of companies that sell really big products, like for example, Caterpillar, you know, those really industrial machineries, a Boeing, for example, what they do is that they realize that their products are very expensive. And so one of the ways that they try to make them more affordable is by creating this finance subsidiary. So it's like the Caterpillar subsidiary or the Boeing subsidiary. And it's basically a loan that they provide to their customers so that they can actually buy, you know, the product. And they understand that their product is so expensive that it has to be made in payments. And so they provide that the avenue for their customers to do that. Then we have insurance companies. So these are businesses that protect their clients against financial losses from certain specified risks. So for example, we have like death, you know, we have injury, disability, fire, you know, natural disaster insurance kind of thing. So there's like fire insurance, and then there's life insurance and things like that. So these State Farm is one of the largest insurance companies that provides these kinds of services. Then there's pension funds. So these are managed investment pools that are set aside by individuals, corporations, unions, and some nonprofits. So again, this is to create a retirement account so that you start putting money in your retirement account so that you can actually have some retirement income when you finally retire. So this is the kind of stuff that I do for my other job as a financial advisor. So we create investment retirement accounts, also known as IRAs and Roth IRAs. So the IRA is a way for you to invest in a variety of financial assets. So everything that you put into your IRA, the interest earned is deferred tax-free until you retire. Then the Roth IRAs were created in 1997, and those allow for a maximum of $5,500 per year after taxes. And so those are not, you know, because you pay the taxes already. You put the money in after you paid the taxes, so they don't charge you taxes on those. But anyway, that's what I do for my other job. Then there's mutual funds. These are pools of individual investor dollars and investments. They put them in well-diversified securities. So it's like a pool of different types of stocks, for example. And then there's a money market fund. So they invest in short-term debt securities issued by governments and large corporations. Then there's brokerage firms. They buy and sell stocks, bonds, and other securities for their customers. So this is all the kind of stuff that I do for my other job. So we use the company that we use to trade the client assets is Charles Schwab. But there's also big ones like Merrill Lynch or Edward Jones. But we buy and sell stocks and bonds and other securities for our customers and provide other services. Most are part of financial conglomerates that provide many different kinds of services. Mine is a boutique. It's a small firm, so we only do smaller accounts. Then there's investment bankers. They are the ones, so I know when we talked about companies going public, they are the ones that deal with helping the company go public. So they will work with the founders of the company, and they will decide, you know, how many shares we be selling, and they create they basically facilitate the process for a company to go public and sell their stocks in the stock market. And then there's finance companies, which offer short-term loans at substantially higher rates of interest than banks. So, you know, I think of these people as like the Quicken Loans. You know, I know there's another one called Pinnacle Financial Partners. So these are commercial finance companies, and they make loans requiring their borrowers to pledge assets. So they could be equipment, inventories, or unpaid accounts as collateral for the loan. So they're very, very strict about what you put as a, you know, in terms of an asset to ensure that you're going to be paying it back. So there's electronic banking. This is EFT. So when you get, when you slide your credit card at the grocery store, or whatever, that electronic magnetic tape ensures that the money goes through. You could do it by paying your stuff online, setting up automatic payments, that kind of thing. ATMs, of course, I think we all have used them at one point or another, but 24-hour banking services, right? You can go to the ATM anytime and take money out or deposit. And then there's automated clearinghouses. So these are the ones where you can, get your check deposited into your account every month, kind of thing. So it allows payments such as deposits or withdrawals to be made by a magnetic computer tape. Most large US employers and many others worldwide use ACH to deposit employee paychecks to their accounts. Some of the advantages of this are that, it's safe, it's convenient, and if you kind of leave the money in your account, some companies some banks will give you like a some kind of bonus if you have an ACH going into the account, or they'll, because you have the money coming in, maybe they'll give you a different interest, that kind of thing. And then there's, of course, online banking, which has really been drastically improving over the last decade. Now you can deposit checks from your phone, that kind of thing. But anything can be done now from a cell phone or a tablet. You can wire money to people. And then we have 62% of adults list internet banking now as a preferred method. And then, of course, we have moving forward, like there's so much technology that's changing how we bank. There's like Venmo, there's Zelle, there's all these different sort of apps and different technologies that are making it, I think, really interesting, to be able to, just say like, hey, let me send you this money. Now we have Apple Pay and the Cash App and just all these different technologies that are coming in. I think that as we continue to move forward, I think that this is going to continue to change and evolve. And I think that technology is going to, I think even further and change the way that we think about money and the way that we transfer money between ourselves. I think as time goes by, we'll use less and less cash and more technology and just transferring. So it kind of makes it interesting because it's all sort of in this cloud, in this internet cloud, right? In this virtual world is where we have our assets, and we have to sort of trust that's going to be the way that we trust our system to transfer our money and things like that. So it'll be interesting to see how technology continues to change our banking system. And then, when we think about the impact of the financial crisis, the Fed took unprecedented actions then, and it changed the banking industry a bit. And now with this crisis, it's going to be interesting to see what happens as a result of that, and how our economy will change, and how the economy changing will impact the way that we think of money and the way that our financial system and banking kind of works. Especially now that, if you guys think about it, we're not, in this example of this crisis, we're not even allowed to leave. We're not supposed to be leaving the house. We're not supposed to be going. If we go to the ATM, if we touch the ATM and someone else that has the virus touched it, so depending on how long this lasts, I think even that will be impacted, the way that we bank. Now everything will have to be online. I know, for example, my bank has a limit of how much I can deposit per day or how much I can withdraw per day. And it's like, if I have to deposit a check, then, if my bank says, well, you've reached your limit, then what can I do? Does that mean that I have to go into the bank? Does that mean that I have to go to the ATM? So I think even this part of the finance system will be changing as a result of this. So I know it's a lot of changes. Shadow banking is another one. And these are companies that perform banking functions of some sort. So this is where Venmo falls into this category, because they're an app. It's just an app, but it performs the functions of a bank because we're sending money. So it's the peer-to-peer lenders. Like Prosper is another company that matches investors and borrowers to loans, and so it's a person lending money to a person, but it's not necessarily a financial institution. So then it's like, what happens, when you can't guarantee the money or you don't pay the money. There's just a lot of considerations, right? And then we have other companies like GoFundMe, Kickstarter, all these that help people raise money, but they're not regulated. And so I think that I I believe that at some point the government will come in and try to regulate these as well if they haven't done so already. Because at the end of the day, you're dealing with money, right? You're dealing with raising money. You're dealing with letting people borrow money and transfer money. And I think that because you're taking on the responsibility as a company, to have people's trust and to be doing things like that. If you're transferring $1,000, if I Venmo any of you $1,000, I want to make sure that you're going to get that money. So what happens if you don't, right? And so I think the more that companies like this continue to pop up, and especially like I said with this happening, and we're going to need more apps like Venmo and Zelle and these types of things. I know even businesses right now are raising money on GoFundMe. So I think the more we use these types of companies, the more the government will have to sort of step in and just make sure that there's safeguards in place so that our money is always in a safe place. So I hope that this was helpful to you guys and helping you make sense of all the crazy things going on in our economy, and as it continues to go up and down, and bounce up and down in terms of, you know, we're having a good day, we're having a bad day, good morning, good afternoon, and then next thing you know, we're having the stock market is up, then it's down, and then the government announces something, the president, the governor, lots of changes. And so